Today we are focusing on trading the trend using ICT concept called the mitigation block. This mitigation block works in futures and Forex trading. It's often credited to the inner circle trader, aka ICT, but I'm not entirely convinced that he is the OG of this concept. I will go into that a little bit later on, but first, why should you care about the mitigation block? You should care about the mitigation block because it is one of those foundational ICT SMC concepts that is going to act as a building block in your foundation later on. Without the mitigation block, you will have the straight up weak ass foundation. And I want you to have the foundation that you can build upon. Now, why should you continue watching this video? Because I am known for being able to break down ICT concepts in a way that make them easy and understandable. On my channel, there is no fluff, no BS, no guru jargon, just straight up value. With that being said, let's get straight into it. First and foremost, anytime I teach ICT concepts, I make sure that I get it correct and I'm teaching you the concept correctly. I may simplify it, but I make sure that it's correct. In a prior video, I had been talking about the mitigation block, and there were some people in the comments saying that what I was teaching was not, in fact, the mitigation block. So for this video, I went and made sure, double check, triple check that what I'm teaching you is, in fact, the mitigation block. And I'm happy to say that it was the mitigation block. I'm not sure if they just didn't watch the whole video or were lacking a complete understanding. Either way, what I did teach was correct. Let's go ahead and break down a diagram here. You have a move up, a move down. This was once resistance. Now, when price returns here, this top here will be acting as support. Why does the mitigation block work? If you're anything like me, you want to know why. I'm a big person on why. It's just how I learn. I'm very curious by nature. If price has a big move up and then it starts going down, traders are going to sell at A. And it puts in a failure swing and reverses and it breaks A. Once price starts moving back down from C and comes back to A, the traders that originally sold short there are going to mitigate their losses and exit the market, thus creating a bounce in price and acting as support. That's why it's named the mitigation block, is because traders have a chance to mitigate their losses here. Most responsible traders will mitigate their loss and exit if they're given an opportunity to. Now we, as the smart money traders, are going to be looking to enter long where they're exiting their loss at. Because if you sold short, you have to now buy. That creates more buy pressure. And if then traders understand the concept, once resistance, now support, that causes you more buying. And then you have a pattern here that is known in the trading community. Now, this is Linda Ratchke's ABC formation. Let's look at a bearish example of the mitigation block. Price would come down, then it would make a failure swing. It would break that failure swing and then return to that low. So you have up, down, back up, and then she's saying to sell short right here. It makes you wonder, is ICT the creator of this concept, or is it Linda Ratchke? I would say that since this was produced in 2004, that she is in fact the creator of the concept. That does not take away from ICT because she has simplified it in a more tradable way. Just to clarify so you understand how it works in a bearish scenario is when traders that buy at A don't take profit at B, and then price goes below A again, when it comes back to A here, they are going to look to mitigate their position, their long position, by exiting and selling, which that creates more sell pressure here. All right, here we are on ES on a 3-minute chart. We're going to look at the price action from Friday, October 9th. That was the last trading day. We are going to go over the difference between the mitigation block and the breaker block. I'm going to talk to the guys that commented in my previous video when I talked about mitigation block, set them straight so they understand price correctly, because the way that they're understanding it is wrong. and then I'll show you how I trade it in a trend, and then we'll wrap it up. I'll go through a couple examples ES and a couple of examples of NQ because I know people trade both of them. Their price action is a little bit different, how they treat mitigation blocks. First off, let's start with the difference between the breaker and the mitigation block. Price moved down here, then it came up, it came back down, running that previous low to the left, and then it moved up, back down. Now this high, this last up close candle here, will act as support because the people that sold here didn't take profit, held through all this, have a chance to get out break even, they're going to take it. And this is a breaker because it ran the low to the left. This right here is in fact a mitigation block. Why? Because it didn't run this low. If it would have ran this low, then it would be a breaker. Now, step one is find the swing high of the failure swing. It's a lot easier when you're first beginning to get the line tool and just draw it out. Now, this high is a failure swing here. High or low, last up close candle of that swing high of the failure swing is going to be your mitigation block. Let's go ahead and highlight this last up close candle before the failure swing down, but price never returned to there. Almost got down there, but not quite. So this is one of those examples where if price would have returned to there, it would be a mitigation block. You have a failure swing here, price moved up, but it didn't come back to the mitigation block. But here we have a mitigation block. Now, this is where the ICT fanboys, I don't know if they're fanboys, I assume they are because of how aggressive they were being in the comments. Usually they're fanboys for like 99% of the time. They're a little bit weird, to be honest with you. But hey, if you think you're right, I could understand how you did that and how you would think that what I'm teaching is not a mitigation block. But hopefully you're still watching my channel and you're going to understand price a little bit better here. So this right here, yes, it did run liquidity to the left, right? It came down, it ran whatever high was to the left, but did it run this low or this low or this low? No, it did not. Did it put in a low and break this low here? It did not. So therefore, it cannot be anything but a mitigation block. I'll show you what I mean. Price came up, put in a failure swing, then came back up, revisited where the previous high to the left. We're going to go ahead and highlight this last up close candle, extend it in time, and it touches it to the tick. Something I like to do on the lower time frames is I'll just put it at the previous high and extend it in time. Why? Because if you look at imbalances and inefficiencies in price, how you're supposed to, and think of it as it being painted over, you have one painted over. Now, yes, there is some spots in here where it needs to come back over. Where does it come back to? Right here, because this is 1, 2. There's 2 in there. So now price moves back up. Now, how many times has this been painted over? 1, 2, 3 times. You have 3 times it's been painted from here to here. So there is not an inefficiency in price here. Both buyers had a chance to buy, sellers had a chance to sell. Buyers had a chance to buy, sellers had a chance to sell. Both buyers and sellers in this area have had a chance to sell, buy, sell, buy, sell. So there's no buy side, sell side inefficiency. So it does not need to fill in this area because both buyers and sellers had a chance to buy and sell in here. This is what makes the mitigation block a great trading tool in trends, because when price goes up and then comes down and back up, where does it need to fill in? Only to this high right here. That's all it needs to do. It doesn't need to go in here because both buyers and sellers had a chance to buy in here. Sellers have not had a chance to sell yet. But once price comes down, it's no longer a sell side inefficiency, is it? No, because they had a chance to sell. Okay. Now that we got that straight, I got the comment thing done without being too aggressive. So I'm proud of myself for that. And then I explained why mitigation blocks work so well in terms of inefficiencies. Here we are on NQ on a 3-minute chart. And instead of going and searching for a bunch of bearish price action, I'm going to show you guys how you can use the mitigation block on really small time frames to kill it. We had some pullbacks in here. Let's drop down to the 1 minute. I bet you. Okay, so there wasn't any on the 1 minute, but on the 30-second there is. Now, for the bearish example, we want to see a failure swing. The last down close candle of the swing low before the failure swing takes place. There it is. We would highlight this doji here. Now when price revisits it, we would sell 2 as it goes into there. We would put our stop above that high. We would sell 1 as it breaks that low. I want it. Why? Because price is going to have to revisit this area where buyers did not have a chance to buy. So it's a buy side inefficiency. So if you guys are saying busy and sibby and you guys don't understand what it actually means, just don't do it. Just say fair value gap. There's no reason to say it. Buy side, sell side inefficiency, sell side, buy side inefficiency. It's fucking too much. Just say fucking fair value gap, an imbalance in price, because it's an imbalance. But if you guys are saying that you don't understand what I explained to you guys in this video using guru jargon, we don't understand what it means. I wouldn't take this one as it didn't dip down very far. Let's go forward. It might work, but let's go forward until we find a example. This would have been one because you had a failure swing here, breaks that low, comes up 50% that candle. You could have went short there for another big trade. So I'd buy back somewhere in there as it fails. If you guys are interested in getting funded, check out my website. It is verifiedfundingcompanies.com. You can head to the discount page. I update this every single day with the newest discounts. You can subscribe to my newsletter, get tips and tricks on how to pass evaluations sent to you 2 times a week. And then I also send you the latest discounts for trader funding. But that's just really like a bonus. All right. Blue Knox 80% off of option 1 accounts. That comes out to about $30 for a 50K account. Apex Trader Funding 71% off and then half price resets. Take Profit Trader probably has the best discount right now. 30% off the valuation, but then no activation fees. So it saves you about $130 per 50K account. And then you also get to keep all profits that are made in October.